started. Welcome to SheFunds Academy. We are today talking about what lenders look for in a borrower file. There it goes. Okay, so to start off, my name is Sydney. I'm the Chief Operating Officer for Simple Lending Financial, like I mentioned, and Diana's an account manager as well for Simple Lending Financial. Then we have Brittney Fairweather, who's an account executive at Archwest, and Kelsey Hawkins, who is the Director of Business Development at Constructive Capital. We're very excited to have Brittney and Kelsey as a part of the SheFunds Academy today. I've been able to work directly and get some conversations and inspiration from both Brittney and Kelsey. So just a big thank you from me, Janine, and the entire SheFunds Academy team for just being willing to share your knowledge and everything that you've experienced as a lender. I'll keep going. So we'll start off. The first slide is we're looking at the borrower. So the borrower is, who are you? Before lenders look at the property, they evaluate the borrower. So what we're looking at is, do you have relevant experience? Do you understand your numbers? Will you have liquidity after closing? And are you organized and responsive? And I'll go ahead and start with some questions for Brittney. When a borrower submits a file, what makes you immediately confident in them?
So the biggest thing for us, and I think constructive is probably similar, but I'll let Kelsey speak to that. We are an asset-based lender, we are a private money lender, but to your point, the first thing we're looking at is that borrower, right? What I want to know and what something that gives me some immediate confidence is not only are you really familiar with your property, are you answering me quickly, do you have solid underwriting, have you done your diligence? But are you honest and upfront about your involvement in the deal? Are you running this as a business or is this your side business and maybe a side hustle? All of those answers are okay. But really, what gives me the most confidence and makes me say, yes, this is a new borrower that I really want to work with is their presentation, their professionalism, and then transparency, really just making sure that they're like, this is the deal. I know my numbers. I have complete confidence in this deal. And then I'll also making sure that they really, really have a plan for their exit strategy.
Precisely. I love that. I'll have a question for Kelsey next. What's the biggest red flag that you see in early borrower conversations?
Sure. So I think the first thing is we're putting trust in our brokers that they're having conversations with the borrowers since we're not directly speaking to the borrowers. But I will say an example that I've had, that's come through a broker is asking about a large deposit and what needs to be shown for the large deposit. And while that's not totally a red flag, the conversation that it led to, it was trying to cover up the large deposit. And I think that that's what the borrower is trying to do. And we really need to focus on being able to document assets because that is very important whenever you're trying to get a loan with us. And if you're trying to mask where those funds are coming, that's definitely going to be a red flag in underwriting.
Yeah. That's very correct. I mean, yeah, looking at bank statements and seeing like large funds come through out of nowhere is definitely like a little concern though, because it's where is it coming from? Overall, it's not like a huge thing to deny a file off of, but it is
Right.
something to kind of ask questions about for sure. I will go on to the next slide here. We have, s- sorry, I'm trying to like, this is my first time using my iPad as a second display. So there we go. Perfect. Okay, Diana, I'll let you take this one. Diana, are you muted? There you
Okay,
go.
so a strong borrower file includes the REO track record and solid liquidity and healthy credit score, clear investment strategy and exit plan, and efficiently formed entities. So, um, Ms. Brittany, I was just a question for you. On the REO, which is one that I run into a problem with a lot of my borrowers, what is it that you can advise for borrowers to get prepared on that?
So really just being transparent and upfront with what you have on your schedule of real estate and in your track record. If there was a partner in the deal, the underwriter is going to dig into it. That's their job, right? We're going to look at everything that goes into that. A blessing and a curse now, especially with the availability of information, we can verify everything that you have. I remember when we first started getting into this business, in like 2008 when we first started lending, people could just submit track records and we're like, well, yeah, unless we have to actually go through physical paperwork to verify some of that stuff early on. Now everyone has access to be able to verify everything. So definitely
Mhm.
don't try and hide something thinking that we're not going to find it. But also having all of the detail that I want to, that's really important. We're looking at profitability on your track record, right? We're looking to make sure that you have deals that have been successful. If there were hiccups along the way, tell me why ahead of time. If it looked like this project took 5 years and it should have really only taken 12 months, tell me why. What was the holdup? So being proactively transparent on anything that does come up in your track record is super important, and not trying to hide anything that doesn't look like a slam dunk. At the end of the day, as a lender, I have way more confidence in a borrower who has made it through some hiccups and is still here, has closed more loans, has made that lender whole. Even if the deal had some hiccups, those things are more confidence instilling in me than trying to make your track record look like it's absolutely perfect with a bow wrapped around it.
Yeah, I think that's great. That's great. Definitely just like the most transparency possible is transparency is the best policy, honesty is the best policy, as they say. But yeah, definitely like with the growth of technology and the growth of information, we can find anything out. You tell me that you were on a HUD, but I can go and find that HUD and make sure if you're on it or not. Yeah. And then question for Kelsey. How do you evaluate a newer borrowers with limited experience? I guess that kind of does go back to Brittany's, but just to piggyback off of that, how do you kind of work with newer borrowers with limited experience?
Sure. We're never going to shy away a new investor. We always want to try and help everyone that we can. However, they're going to be more of an exception basis because they don't have that experience. So we're going to ask extra questions. How are you going to manage this property? Is a property management group going to be involved? We're also going to ask that they do an online course so they have a little bit more experience when they come to us. And they might have to show a little bit more assets than, a traditional borrower that has experience. So those are just some things that we're going to ask for up front.
Hmm. Hmm. Yeah, I love that. And doing the little course too probably helps them too. There's probably
Mhm.
so many things that people don't know what they're going into. And
Right.
course like that, preparing a new investor can definitely give them some more insight because more often than not, I have people asking me about like the draws. How do the draws work? How do
Mhm.
my payments work? Everything like that. Like any sort of information you can give them is definitely a huge, huge bonus, I think.
For sure. And having, the property management group involved is definitely going to be an added bonus for someone that doesn't have that experience. If they don't want to keep them long term after they get more experience, that would be up to them, but that would be a requirement we'd want to see for a first time buyer.
Yeah, yeah, absolutely. Back to Brittany with the last question for this section. How much does communication style impact your perception early on?
I mean, it's instrumental. So, I mean, if I have someone who is very clear, very direct, responsive. If you can tell they're not searching for answers and they just are conversational and they know what they're talking about, they're immediately in my mind a lower risk borrower. And the same thing goes for brokers, right? If they know that they have answered these questions up front, they've talked to the borrowers, they can get me those answers right away without being like, oh, I didn't think to ask that question. Like all of that preparedness just immediately makes me that much more confident.
Yeah, absolutely. Absolutely. Last question for Kelsey in this section. How important are liquidity reserves in your approval decision?
Very important. That's gonna be one thing that you as a broker are gonna wanna go over with the borrower because again, we're not talking directly to the borrower. So it's gonna be important as a broker to verify that they have enough liquidity for the required reserves and also for any down payments they might have if it's a purchase. So I would say that that would be top 3 in the items you'd be looking for. Obviously, credit, the property itself, and then assets are gonna be the top 3 things you wanna look for.
Hmm. Hmm. Absolutely. Janine put a question in. I'm just going to go ahead and go off on it just because we actually are on the topic. I think you might be able to. Yeah, there it goes. You can see it on the screen. How many years back to do you take experience into consideration, both for Archwest and constructive? So, Brittany, do you want to go ahead and answer that?
Yeah, we go back 3 years. So we look at the most recent 3-year history, for borrowers who do larger projects, who either do small balance multifamily or development deals or larger luxury projects. Those are case by case basis because we understand the cycle time of those investments are much longer. So we maybe go back to look a few years beyond that initial 36-month term.
Mhm, mhm.
Oh, it's a good one.
Kelsey, how about for constructive?
Well, not to copy off Brittany, but we're the same here, constructive. We go back 3 years, and again, like they said, if they have something a little outside of 3 years, it may be considered, but yeah, 3 years is how far we go back.
Mhm. I think that's the rule of thumb pretty much with all investors is the 3-year,
Mhm.
um, 3-year marks. It's good to know that, and I more often than not, I feel like I have a borrower come through and they try and give me an experience from 2007 and be like, "Oh, well, I was an investor 20 years ago," but it doesn't work like that. So
Yeah, and I think, things have changed since then, building has changed, requirements have changed, so I think that's why we stick at that 3-year mark because it's
yeah,
more accurate than, like you said,
yeah.
2007.
Absolutely. So we have Suzeda sent in a question. What do you mean by efficiently formed entities? What is an example of an inefficient formed entity? I can go off on this one. So, efficiently formed entities, that would basically just mean most lenders are going to look for either an LLC or an incorporation. Most lenders aren't going to fund to nonprofits and things like that. And then inefficiently formed entity would be, in my opinion, something that is like not if you are adding a borrower onto your operating agreement, having that tracked all the way back to your articles or having an amendment in place that's going to also help with that. So I see that a lot of times that someone is just added onto an operating agreement, and in the end, they weren't ever actually formally put onto the entity. They were just kind of added on for experience or for credit or anything like that, which can be something that happens. You can partner with more people. It just needs to, in the end, be amended and filed correctly with the state. Brittany or Kelsey, do you have anything on that too? Or
No,
Diana too?
I'd say that that's exactly accurate. We do
Yeah,
a
I
lot of
agree.
times see people partnering together. It's more common in other markets too, especially in ground up construction, where you see a developer partner with a builder or their equity partner is coming in and they have all these different combined strengths. Um,
Mhm.
but documenting their roles and responsibilities in the deal along with the ownership structure is really important. And having, to your point, Sydney, having accurately documented their involvement on the operating agreement and properly filed is going to be hugely important.
Absolutely. And we have another question. This will be the last question for this section, then we'll move on. But from Ben, can cash out count towards the reserve requirement? Brittany and Kelsey, do you both want to give some input there?
Here at Constructive, yes, they can. We can use 50% of the cash out proceeds towards the reserve requirement. So as long as that covers your reserve requirement, you're not even going to need to provide bank statements.
Same. 50% of the cash out can be used for the liquidity requirement.
No, that's a huge thing to have, I think, because people, I mean, they got all their money in their properties, so they don't have that liquidity to show. So that's why they're doing the cash out is to have that money.
Right.
Awesome. Okay, I'll go on to the next slide. Let me see. Is it gonna go? Ah, there it goes. Okay, so the real question is simple. If we fund you, will you execute? On to the next slide after this one. So this one we're looking at the deal. So the deal itself, does it actually work? Lenders will underwrite math, not emotion. What we review is going to be purchase price or as is values, ARV in relation to the market, a rehab scope for builds and flips, a project timeline, exit strategy, and overall the profitability for the property. And let me see my questions. Um, Brittany, what is the most common mistake that you see in a borrower's deal analysis?
So the biggest thing we see that I get kicked back on from both my underwriters and my construction team is an insufficient contingency in your rehab budgets. Huge red flag, big, major, important element to the underwriting is that you, as a borrower, as a developer on a bridge loan, a new construction, rehab, whatever it may be, have properly accounted for contingency because things go wrong. Things change in real estate development all the time. Now, if I get a budget that doesn't have a contingency line item and the borrower tells me that's because I've baked it into my individual line items, well, that's fine. Adjust your budget, give me the contingency line item, because then I need to get a proper feasibility study that actually
Mhm.
goes and matches the line item costs, not including the contingency. So that's a big thing. If there's ever any budgets that don't match plans, I've had people submit a property to me that had a pool, but there was no line item for the pool in their budget. I'm like, well, are you going to pay for the pool out of pocket? Like, I need to know the total cost of this project because that ties into my profitability. So making
Mhm.
sure that your rehab budgets actually match the scope of work that you're providing is another big one. And then the next one really is improperly accounting for holding costs, taxes, insurance, anything like that that's going to obviously directly affect the profitability of your loan or of your project is a big one that I see. Underestimating holding costs and what that will do to your line item, to your bottom line, and including in cost of capital. Not
Mhm.
including if you haven't properly budgeted for the interest payments or whatever you're going to pay your equity investors when the deal's said and done, those holding costs also need to be properly accounted for and make sure that they really are going all the way down to the bottom line.
Yeah, yeah, I love that. Question for Kelsey. At what point does a deal become too tight to move forward?
Two I think this is twofold question. Whenever you're saying too tight, are you meaning like as far as the profitability as the overall deal after, the construction is done?
Yeah, yeah, I would say that, yeah, the margins being really thin when it comes to yeah, like a construction loan. Um,
Yeah.
seeing like the
I would
profitability
say
there.
whenever we're not meeting the required minimum ARV, that's when we're going to see. And then also whenever they're like Brittany was saying with the line items, like making sure the budget is specifically detailing what the line items are and what is within that scope of work. That's going to be, the key to finding profitability within these loans.
Mhm, mhm.
I have a
Yeah,
question for
profitability
Brittany.
is a huge one. Oh, go ahead, Diana.
At the end of the day, how much liquidity do you want to see on a ground up construction aside from their closing costs?
So we want to see 6 months debt service if you're not going to have a lender funded interest reserve. We're going to want to see 10% of your construction budget, the whole budget, not just what's left, the whole budget, to make sure that you have the ability to get the work started and going because we are a work in place. We don't fund from draws. Um, and then we're going to want to see any closing costs in addition. So those are the three things that we calculate.
Oh, yeah. And how
That's
fast can someone draw on their construction budget?
As soon as a loan closes, they can make a draw. We can if they have I mean, and as soon as it closes and it boards with the servicer, then they can request a draw. So we have some borrowers who get projects started to keep interest costs down. They'll get started, they'll acquire the land, and they'll be ready to pour foundations as soon as we close. And so we can usually get that done within 48 to 72 hours after closing. We don't have a minimum draw requirement, so I'm not going to tell you that you can't make a minimum draw, but there is expenses associated with the draws for the inspections and the wire fees and things like that. So we'll make it as easy as necessary that goes in line with the borrower's, flow of capital and operations. But generally, we can get funded on a draw as soon as we close, 24 to 48 hours, 48 to 72 hours afterwards.
Nice.
Yeah, I was just going to mention to that question, I would make sure that they have enough to request the draw. They don't want to just be requesting small draws and increments. Try and bulk as much as you can together if they can afford, to get repaid from the draws, because like Brittany said, there are fees associated with it, and you just don't want to be doing a bunch of small draws at one
Mhm.
time.
Yeah, I think most investors they kind of try and work in phases. So I get asked that question all the time. I think I got it asked like twice yesterday and three times today. So how did the draws go? And I tell them it's really at your own pace. Like whatever you want to do, you can work in phases. You can do half of the project and then get your funds reimbursed, or you can even complete all of the work and then get it 100% reimbursed from there. But it's really just dependent on what you have and your own personal liquidity and also what pace you want to work at too. And I think that sometimes it surprises people. They don't expect that. They think that they have to be under our rules.
Hmm.
Yeah. I'll go into the next slide because the questions that Diana was asking actually do feed into this next slide. So they're looking for profit after. Do you want to take this one, Dee?
Sure. So they are looking for profit after closing costs, operational costs, and costs to start the construction, unexpected overruns. So on the closing costs, typically when a client prepares himself to close, we provide them the final HUD. Um, is there any changes last minute that they need to look out for when they're getting ready to close? Like what not to do,
Yeah, that's a
Brittany
good
or Kelsey?
question.
I would say I would not switch the scope of work right before closing.
Mhm.
That would definitely be something that, would throw off the whole deal, especially because we've already factored in, the LTV, how much we can lend on. And if they're changing the scope of work right before closing, that's going to definitely, cause the file to have to go back and underwriters are going to have to re-review that, which might affect those numbers. So I would shy away from changing anything on the scope work right before closing if
Yeah,
possible.
it's happened to me.
Yeah.
Yeah.
That exact scenario has happened to Dee.
Oh, no.
Yeah, it's
Brittany, how
important
about you?
to know too, just going into that, like everything that's come up to that point, right before you get closing, underwriting and everyone that's worked on your loan is operating under the assumption that something is going to be done. One thing is going to be done, what you represented in the beginning, right? So if you want to go and change that after the fact, then you're going to cause a bunch of delays, a bunch of more expenses, because then you're going to have an underwriter go back and look at a change in scope that now changes your ARV, it changes your possible, interest from a buyer perspective in the
Yeah.
market, right? So you're going to want to make sure that that's all really buttoned up front for sure.
Yeah, absolutely.
Yeah.
Um, Janine asked a question. What LTARV do you go up to on a fix and flip? I'll leave that for both you, Brittany, and Kelsey. I'll put it up on the screen too. There you go.
75%.
On certain markets, we will go up to 80.
Wow.
And what markets are those? Because I really would love to have business from there.
It's I can give you the list of the markets after the fact. Yeah.
Yes.
Yeah.
It's generally markets where where our capital markets and our underwriting teams are not seeing declines. It's really quick projects that are going to be done really quickly that we're not worried in any kind of dip in the market. Um, Generally on those higher LTARV loans on fix and flips, we're also expecting our borrowers to not be requiring not maxing out the LTCs.
Hmm.
So, kind of all those things go into some of that analysis.
Yeah, absolutely. Um, I would like to go on to this next section, probably every underwriter's favorite section, which is talking about risk. So, risk, what could go wrong? Every loan decision is risk management. Lenders will evaluate liquidity left after closing, experience compared to a project size, the market conditions, construction complexity, and a backup exit plan. Brittany, what risk factor do borrowers underestimate most?
Um, I think that for the most part, experienced borrowers, um, they anticipate possible cost overruns for the most part. That's again where the contingency line item is there in any budget.
Mhm.
Um, what they don't always anticipate is the expenses associated with holding costs when a project runs over. All those additional things, your interest, your taxes, your insurance, um, permitting costs, and inspection costs, and any possible city fees that are going to come from, improperly permitting a project, right? Some of those things, I think borrowers maybe try and maybe kind of try and get around and underestimate. Um, and the other thing is really, to your point, a backup exit strategy, right? We're going to look at what happens if the market softens. Is this going to be able to be flipped to a rental loan, or is it going to really be subject to getting that right buyer? And that's going to be a little bit of a red flag for us.
Mhm. Mhm.
Kelsey, question for you. What does good contingency planning look like to you?
I would say having a plan B, making sure that you have those assets, making sure that you have reserves, much like Brittany said, making sure, you have enough to cover for those unexpected costs. So just always planning for the unexpected would be a good contingency plan.
Yeah, I agree.
Yep.
Okay, I'll go on to the next slide. Diana, you can take this one.
Sure. Okay, what they are asking. In the timeline stretches, are you prepared? If the costs increase, can you absorb it? And if the market softens, can you pivot? Strong borrowers acknowledge risk and plan for it. So, one question that I do have is on the borrower, we're on the capital provider side. What is the biggest factor and the risks involved with a heavy rehab? If the borrower doesn't have the experience for heavy rehabs.
Hmm. So for
Yeah.
here at Constructive, for any heavy rehabs, we are going to require that they do have ground up construction. So we are not going to be taking those first time investors, first time rehabbers on our ground up. So I would say it's definitely important to have that experience when you're coming to try and get a ground up loan and being able to document that experience.
And for heavy rehabs as well.
For heavy rehab, I'm sorry, no. For heavy rehab, we're gonna need 3 to 5, experience projects in the last 3 years.
Yeah, well, I mean, we're
So,
similar. For ground up construction, we're going to require that the borrower has either done ground up construction themselves, or they have a GC that they have a contract with that has the experience with ground up construction, not just renovations. For heavy rehab, it sometimes that can be jurisdictionally based, what our requirements are, because there are some areas where the cities and the states don't require as much. Um, but what's going to be really important from me in those situations is having a borrower who knows those requirements and also is up to date on the requirements if they're changing. For example, there are some counties in Georgia that are all of a sudden trying to change the way they're doing ground up construction requirements when it comes to applying for your permits. And if my borrowers don't know that and I have to be the one to educate them, that's a red flag for me.
Mm.
yeah, yeah, absolutely. Um, Brittany, I guess that kind of answers my next question a little bit. How do you assess market risk in today's environment?
So, from a market risk perspective, shifting not to the buyer themselves, but the market, I mean, we're going to look at days on market for the exits on the sale side. We're going to look at, has the market seen a lot of price reductions? Is that common, in that price point for where the exit price is expected? Do we have any issues with absorption? That's really more something that we're going to look at if we're expecting to do a small subdivision or a larger portfolio of rental homes. What is that absorption? Are we going to be seeing extended days on market because we don't want to flood the market with the same type of product all at once? And then we're going to look at inventory levels. We're going to see what the demand is in the market in that price point, and then also anticipate what type of, if it's a for sale property, what type of buyers have an appetite in that market for that price point, for that asset type. If it's a rental property, what's driving people to be looking at rental properties there. So really understanding, the end user that's going to be occupying that property and what their driving demand is.
And I have a lot of
Absolutely.
just to kind of go into the ground up construction because a lot of my clients are ground up builders and they're in a deal. It's typically 12 months. What if they're at the 12th month or 11th month and they're not completed? What is it that they need to do in order to get ready? If let's just say the loan's expiring in 1 month, do we contact let's just say you and say, I am not completed yet. What do I do?
I mean, absolutely. Being more proactive is better. I will say that from Archwest perspective, my construction team is incredibly diligent. So if they're seeing that we're like at 9 months and they're like, this project isn't going to be done by the time we mature, they're reaching out to me and they're saying, hey, you need to get in touch with this guy. You need to make sure that like this is on track. What's going on? Do we need to be pivoting here? Do we need to look at an extension? Was there a change in the plan? But the more you can do up front when you know that that's going to be the case, just to communicate with your lender and say, hey, what are my options, right?
Yeah.
Generally, if you've made your payments on time, you've been clear in communication and have been transparent with your draws, and that process has gone smooth and seamless, it doing an extension for a viable reason is not something that's unheard of at all.
Yeah.
It actually blows me away sometimes when I get people that are like, "I'm at maturity and I'm almost done, or I just listed it and my lender isn't gonna extend." Then I'm like, "Well, why? Did you do something to them during the course of this deal that, like, I should know about?" But I mean, it's just some lenders, it's just not their business purpose to want to do that.
Yeah.
Suzeda asked a question in the chat. For ground up construction, would you consider a borrower partnering with an experienced ground up construction mentor? Kelsey, I'll let you take this one.
Sure. So for partnering, yes, we could, but they would need to come on the loan as the experience. Meaning we couldn't just take it as a mentor. They would need to be a guarantor on the loan as well.
Yeah, that makes sense. Makes sense. Brittany, is there any just going off of that question too, um, or Kelsey too, but either of you can answer this one. When it comes to having that same scenario, the ground up construction sponsor, is there any cases where you accept like someone has maybe one or two rehab experiences under their belt, and then the GC, the contractor, is open to signing some sort of like completion guarantee? Was that something that either of you would look at or accept?
Yes, we have seen that. We're always going to require that GC. So having them sign on with that completion would definitely be something that, we would definitely look at as experience. We're always going to want them to have ground up experience, but it's something that would be a case by case basis.
Mhm.
Yeah, and pretty much the same answer as Kelsey.
Mhm.
In that situation, it would be an exception based decision, and so we would want to look at everything that goes into that loan. Borrower's experience in the market. Is it something that's being overbuilt for the market, or do they have the right team in place to be able to sell quickly? And obviously, if that ground up the GC is coming on to be able to help, we'd want to make sure that that GC is really helping to make sure that they're involved throughout the whole process to make sure that there aren't any construction related delays, that someone who hasn't done ground up construction maybe wouldn't be familiar with navigating.
Mhm. Mhm. Zeta asked a follow-up question. Do they need to be on the entity docs? I think another important question is at what percentage? Do either of you require a certain percentage? They need to be over 19%, under 19%? Because typically that 19% is the threshold for someone being deemed a guarantor or non guarantor.
Yeah. So here at Constructive, if they are a 20% owner, then they could come on to our loan. So if they were wanting to come on as a guarantor, we would require that they're 20% in the entity.
Would that be the
Our
same for the ground up construction mentor? They would need to be 20% or more?
Again, like with the mentor, we would only, we would need them to come on as a guarantor. So yes, they would need to have 20%.
Mhm. And
We won't
Brittany, how about
require 20%. We won't require that they be over that 20% threshold if they're coming on. If we're using their experience, we would require that they be and on the operating agreement on the entity as an owner in the project. But we wouldn't require that they meet that 20% threshold.
okay. Yeah. No, it's good to know those things. It's good to know because a lot of times people are wanting to bring on their GC onto the loan, but they don't know. Most of the time, I guess, ground or general contractors, they're not wanting to be a part of the loan. So it's an important aspect to know is if they need to be a signer or I will go ahead and go on to the next slide for us. We're going into another section, which is going to be the file, presentation and execution. The file itself communicates competence. A strong file includes. Oh, actually, Diana, I'll let you take this one. Let us know what a file
Yeah.
includes.
So yeah, we want to see the purchase contract, and one of the things on the purchase contract, you want to make sure it's under your entity. So that's one thing. I know a lot of um investors, they'll put in an offer and they put the the name. And when the underwriter or processor takes over, we're going to ask for that change. So that's one advice I would want to see is just like that purchase contract, making sure the entity's on there. And the detailed scope of work, strong credit, reputable general contractor. And I have questions with that. Brittany or Kelsey, if there is a GC on the deal and there is they don't have a license here in the state of Texas, not required. What do we require from the GC? Do we need like a license or like is any credentials that we would require from the GC in case we need that?
We're going to want to see a license from the GC when reviewing that. So yes, definitely a license is important.
And then smart entity structure, since we already went over that, and the ARV comp. So if you have those six, makes a strong deal happen. We can price you out. And because we work with a lot of brokers, so they bring us deals, and sometimes it's half. They'll have the detailed scope of work is halfway done, strong credit. Like sometimes we'll pull only two credit scores or sometimes even one. So having those six together makes a solid deal for us to be able to price the broker out. But yeah, Sydney, since you're the one that accepts our deals, do you have any advice for that? Like if I bring you a deal like this and some like let's just say the entity structure is off, you kick it back to me.
I do.
So yes,
I
she
do kick it
does.
back to you.
I mean, I try, right?
Um,
But like,
yeah. I mean, essentially you want everything to match too. I personally I run everything based off of the loan application that's given to me. So, if I have a loan application and it has three people on there, but I see that on the operating agreement that there's only one person, I'm going to ask some questions about it. And then same goes with looking at the entity structure. If it has two, three people on it, but I see on the EIN or the articles that it's a sole member entity, I'm going to ask some questions about that too. So I personally I do run everything back to the loan application, but then also the entity docs because at the end of the day, that's kind of like what for to me at least is the backbone. The entity is going to kind of structure everything that I can do based on what how you set it up, and then the loan application as well. If you're giving me different information, you say that the scope of work is going to be 50,000, but then you end up giving me a budget for 75,000. That's going to change some numbers in there.
yeah.
And then with the credit score too, that's the biggest thing I think we see sometimes is that someone's saying that they have 740 credit and then it comes back as 620. Yeah.
Awesome.
Um, that's a little bit what I look into, as well as the ARV comps. I mean, I feel like it's a little bit easier than people kind of think it is to find some comps. More often than not, I see people like they're trying to look for comps that are way differently than what they're trying to look to do. Like they're looking at they have a 3-bedroom home, but they're looking at something that's a 5-bedroom home, or something that's more square footage, more bathrooms, more has a pool, one has a fence, like things like that. It's really important to look at your scope of work and see what you're making, what you're building, and look at those kind of comps because if you're building something that has 6 bedrooms, but in your neighboring market, there's nothing that has 6 bedrooms, that's going to be a little bit constraining on the ARV comps. Ideally, we want to see those within like 1 to 5 miles, not too far, and not too much variance on the date that it's sold and the square footage and all of the comparables on that. Yeah.
Yeah, I'd say it's
Okay.
really important. The other thing that you can add to your like perfect borrower submission is really understanding what you're building in your market and making sure that you're not over or under building. If you're in a specific market where you know that this property is not going to sell unless it has a pool and you don't have a pool, like I want to know what the justification is for that, you know? If you're putting high-end finishes in a property that does not is in a market that doesn't require high-end finishes, then, you know, you're gonna be overbuilding for the market, but the flip side goes to that too for underbuilding. So I think just having a really good idea of your business plan and your strategy for the market specifically kind of just puts a bow on the whole thing.
Absolutely. Question for you, Kelsey. What do you think separates serious operators from hobby investors?
So your more serious investors, they're going to come to you. They're going to be organized. They're going to be fast in getting you the documentation. They're going to know the market that they're purchasing, the land or the property in. They've done their upfront research, and they know what they're getting into. I think the more hobby investors, they're not doing their upfront research. They're not going to have the documentation you need on hand, and they're gonna need a little bit more coaching than the, more experienced investors.
Yeah. Yeah, absolutely. They might be like a little slower on getting you documents, on communication, because typically with hobby investors, they have a full-time job on the side too. So they're at
Right.
their day job and then they have to do their investing documents and emails like on the weekend or at night. So overall, it's probably just a longer process.
Yeah, those experienced investors, they're treating it as their business. So this is what they do, this is how they're making their money, so they're gonna get you whatever you need in a timely fashion to make sure that their loan is getting to closing.
Hmm. Hmm. Yeah, absolutely. Brittany, a question for you. What's one simple thing that borrowers can do to speed up approvals?
Be organized. I
Yeah.
mean, I had I had one borrower, I could have kissed him. Um, he sent me a Dropbox link to everything that I needed with folders and organized and named properly.
Hmm.
Sub-entities were in the folders for the, you know, that rolled up to the main ownership of the entity structure. Driver's licenses were there. Everything was like it was beautiful. I didn't have to ask him for a single thing. Now, not everyone's going to be like that. I mean, by
Hmm.
nature, right? Some of our clients as general contractors, they're not necessarily always the most organized, but to take the extra time to go through those steps and, you know, we send a really detailed needs list. It's not difficult to just, you know, check them off the list and go down there and attach, 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 you know? So the most organization is going to absolutely speed up approvals.
Yeah, absolutely. That's like every lender's dream is to get the link that has every single file you could ask for in it. There's no questions asked. You can find it on your own. Yeah, I'd love to get more files like that, honestly. I'm going to go on to the next slide just because we have about 9 minutes left. So I'm going to go ahead and get this through, close us out, and get some questions answered by the Q&A chat. Last slide is just a reminder. Incomplete files will slow your approvals. Disorganized files can create doubt, and prepared files move quickly. Just as we were all just discussing in this last section, having things together helps so much, and knowing what you're talking about helps so much. And just making sure that you're prepared overall will help the lender, helps underwriting, helps all aspects of the loan, just knowing what you're talking about and, um, yeah, just knowing what you're doing gives a lot of confidence to a lender. Um, I have some closing questions for both Kelsey and this is gonna be for both Kelsey and for Brittany. So, first one is, what is one thing that people can start doing today to become more fundable? Brittany, I'll let you take it first.
Just being more conservative overall in your approach to your deal, right? The more you can kind of put your lender hat on as you're working on something and put your underwriter hat on and start to ask yourself some of those questions, the more fundable you will be, the easier it will be for a lender to make heads or tails of your deal. So things like even being more conservative and adjusting your expected ARV down 5% lower than where you really think it's gonna land. Having that contingency. I mean, we used to have a hard guideline for a 5% contingency, starting to see that creep up towards even 7 and 10%, especially on ground up construction. And even just extending your timelines out a little bit, just getting a little bit more conservative all over to make sure that you still have a strong margin in that deal is going to make it that much easier, and give lenders that much more confidence, in your knowledge of your deal overall and your capability as a borrower.
Mhm, mhm. Kelsey, I'm gonna give you a different question, actually. What mindset
Okay.
separates fundable borrowers from everyone else?
Sure. So I think the fundable borrowers, their mindset, they are going into the process knowing their FICO's where it needs to be. They've already analyzed their credit score. They're probably tracking their credit score daily just to see where there's at. They're organized. They're able to provide you with, the bank statements and their track record, and they're able to document everything. Being able to document everything is very important, and being organized is number 1, like Brittany said with the Dropbox. I mean, yeah, I'd wanna kiss that borrower too.
Yeah, I know that's like the best case scenario, really. I'm going to go on to our very last slide, which is just going to have a QR code for the SheFunds Academy WhatsApp group, and then I'm also going to leave in the chat box a couple links. So it's going to be the WhatsApp group, our Facebook group, and also an Instagram profile. So makes it easy for you to click those links and to get involved with SheFunds Academy. But thank you so much for everyone for joining. Thank you, Kelsey, Brittany, and Diana for being on the She Funds Academy webinar with me. I'm going to go through and do some of the Q&A right now. So Janine asked a question, how do you view bridge loans without a certificate of occupancy? Kelsey, do you want to take this one?
Sure. So, our bridge loans here, generally, we're lending on, let's just say that they're already gonna have that certificate of occupancy because they're already working on the project. I don't know if maybe she can elaborate a little bit more as far as
Yeah.
bridge.
Janine, do you have a more of a scenario there, or do you want to elaborate a little bit? She might be
Because
busy.
generally our bridge loans, like, we're taking a project that may be completed, but they need more time to sell it and or get a tenant in there. So are you saying, like, maybe they're not able to get that certificate of occupancy because 'cause they're not completed with the project yet?
Yeah, I would think sometimes, like, at least in Houston,
Mhm,
just I've experienced this before where, there's only one energy provider and
mhm,
sometimes really, really slow with getting everything connected. So
mhm,
sometimes I've had borrowers, in Houston that they want to go on to their next project, but
mhm.
they're not selling, they're holding, or they don't have that certificate of occupancy yet because they can't get Reliant Energy out to do those inspections for them. So, yeah, I guess that might be kind of where Janine's coming
Understood.
from with that.
Okay. And I think that would be on a case-by-case basis here.
Yeah, yeah.
Yeah, we do, recently, I think because of a lot of these experiences that borrowers and, developers are having, we've been doing a lot of bridge refinances where they're projects are completed and they either need more time to sell or they are just waiting on that final C of O. I mean, I've had some that are even in contract to sell but are waiting on that C of O to be able to transfer title to the property to their new borrower, but their construction loan is up and they don't want to keep paying the high cost of construction debt. So we'll just do a short-term bridge refinance on that. Um, we're really only going to be looking at the completion status of the project. So the fact that we don't have a certificate of occupancy on a completed project wouldn't really give me cause for pause if they were an experienced investor, experienced developer. We understand sometimes, cities just need to make money. Everybody's broke.
Yeah. Sometimes things just happen. Jennifer asked a question. It looks like it's a little bit of a specific scenario. Do y'all lend for people trying to do co-living, like pad split, where build few more walls and probable bathroom? There are no similar homes in the area, but should be compared to apartment rents. Thank you. Seems like it's probably something that's a like a door-to-door rental. So not exactly like units, but just by door.
Unfortunately, we do not do any kind of lending on single room occupancy or pad splits. If it doesn't qualify and can't be a short-term rental, then we wouldn't really that midterm rental kind of project, unfortunately, is not a fit for Archwest.
Yeah.
Same here. We would not be able to
Yeah.
assist in that. Sorry.
Yeah. Yeah, I haven't seen much lenders be able to do something in that kind of scenario. Suzetta asked a question, walk me through your submission to close timeline and workflow. We only got about a couple minutes left. So what's a quick step by step of the submission to close timeline? If Kelsey, you want to do that one?
Yeah, I mean, we generally ask for 2 to 3 weeks from submission to close. With that, it could be less, it could be more. It just depends again how organized the borrower is and how quickly they are to turn around those documents that are being requested. So, if you have someone with a Dropbox, you might be closing tomorrow. But if you have someone that is, texting you single pictures of their bank statements, it's gonna probably be more 3 weeks till you get to the closing table. I think the longest part is what you want to tell your borrowers is going to be getting those documents up front, ordering the appraisal, getting title in. So just setting those expectations and setting that buffer to get those documents.
Yeah,
Yeah, appraisal and
absolutely.
title are the two biggest delays on it. I mean, other than getting accurate and complete documents in for the borrower and the deal itself. But from a third party vendor perspective, if you can, get your appraisal, get the items that you need for the appraisal in ASAP, right? You need a budget and you need a purchase agreement if it's a purchase. And you need plans if it's a new build. Can't order
Mhm.
appraisal without those documents. So those things, get them in there, get that appraisal started right away so that we can start moving on that. Communicate, pay the appraisal right away as soon as you get the link for that appraisal payment to go out. Like those are the things that really timely can just help expedite and move things along because otherwise you're at the mercy of third party vendors. And as much as I'd love to be able to control title and appraisals,
Mhm.
not something I had the power to do.
Yeah. I get that question all the time too. Well, can you get them to move faster? Not really. It's a third party vendor. I don't control them. Okay, amazing. Thank you everyone for joining. Thank you, Kelsey and Brittany, for being on here. Again, on the QR code is going to be for the WhatsApp group. And then in the chat, I also did drop the Facebook group and the Instagram. So you can connect further with us there. And then if you'd like to be connected with Brittany and Kelsey, just send us a message and we'll get you their profile links and emails. But yeah, amazing. Thank you all for joining, and we'll see you on the next SheFunds Academy, which is going to be on March 25th. So yeah, we'll see you in a month. Thank you.
Thank you.